All right, we are back with another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
Doing great, man. I always look forward to this because this is kind of my last and final discussion of the week. It lets me go look back, and also I get to go train for my marathon. So it's a good end of the week and start of training. So thank you for this.
I love it. What's your mileage this week? What do you do on your long run?
We've already done the long run. We did the 20 miler, so now we're kind of selling back. I think I'll do 8 to 10, kind of just maintenance miles, 3 weeks out from the marathon.
And your event
The
is
3rd of November.
3rd of November. I love it. In Las Vegas, yeah?
Correct. Yep.
Love it. Love it. Okay, well, here we go. And you've already done the 20. So
Yeah,
let's
it's
get
it's all it's all downhill from here.
it's all I love it. Let's get right into the show. This is for October the 11th, 2024. Jobs. What happened over the last 7 days? And talk about it. I think this was impactful.
Yeah, last week we had only talked about two of the three jobs numbers. We recorded Thursday. Friday was the big number, and it came in hot, hot, hot. We're going to talk about that in a little bit of detail, but on the surface, I think expectations were like 140, and it came in at 260 or 257 or whatever. So the headline number was much more than expected. And there's a couple of things to realize about that, and we're going to talk about it more later. Is the Fed was really setting us up with their 50 basis point cut to create a soft landing because the narrative was the job market is at risk. We've won the battle of inflation, but jobs are falling apart. And lo and behold, on Friday, again, the headline number said jobs are not falling apart. In fact, they're getting stronger, which puts the Fed in a very interesting spot, which makes rates get more expensive. More on that in a minute. So again, I've been very clear. Thus far, the headline number was strong. However, if you want to nitpick, and I don't even think it's nitpicking, but if you want to go below the surface, I think this number of 257 is really, really dirty, really, really suspect. Inside this number of 257 is the largest seasonal adjustment for September ever. Inside this number, there was something like 750,000 teachers counted, which is not traditional. Again, 30 number. There was a lot of part-time versus full-time. And again, this number, folks, if you have 2 or 3 jobs, you're counted 2 or 3 times. So I think I think this report is undoubtedly going to be revised and probably revised lower significantly. It had a very low participation rate. There was frankly nothing good about this number other than the headline. But the headline means something. As we're about to talk in a minute, that headline blowout caused a dramatic change in the cost of capital. It dramatically changed the mortgage market. It dramatically changed the housing market. And again, I think it's a dirty number. But in reality, it doesn't matter if that's what I think. The reality is the cost of capital changed for home buyers, for business owners, for investors, and it changed in a dramatic and immediate way. So, yeah, the jobs number blowout, really dirty, doesn't matter. It changed the game.
Changing the game. I want to connect the dots too. You've been talking about the importance of the job market. I feel like most of the year for sure, hardcore over the last 90, 180 days, the last six
For sure.
months. That's
Yep.
been a big theme of this show for sure. We said rates are directly going to be tied to 30-year mortgage. What happened in 30-year mortgages this last week? And explain to the audience
Yeah.
give them a little bit of a breakdown and some insight.
So again, if we go back 2 weeks, heading into the Fed rate cut, again, folks, the Fed does not control mortgages.
Yep.
The market does. And usually it's based on the 10-year plus a spread. Going into the Fed rate cut, we hit a cycle of 6.11. That is the market pricing in Fed rate cuts ahead of time. The Fed cuts 50. The market doesn't move instantly, but starts to say, hey, the Fed's telling us the job market, the job market, the job market. And suddenly we start to reprice and rates start to go up. Then we get a monster beat on Friday. The mortgage market moved up 27 basis points in 4 hours. That is wild.
Yep.
Wild. The mortgage market is now up, depending on where you are in credit score and down payment, somewhere between half, 50 basis points, and 60 basis points. So again, the Fed cut rates. The Fed will undoubtedly cut more, but the cost of capital is up. The 10-year note is up. The 10-year note as of this morning or this afternoon is up over 4.1.
Yep.
It's up in a big way. So again, if you're a novice investor and you're not paying attention, you hear Fed rate cut, you think mortgage is down. It doesn't work that way. In fact, David Rosenberg has done research and now found out that 9 of the last 10 rate cuts, first rate cut, the 10-year note initially goes up 9 out of 10 times. And even I would not have known that. I would not have understood that, but it did, because the Fed cuts for a reason.
Yep.
So again, I think most people were caught off. Probably 90% of people, 95% of people were caught off by the sheer, I mean, in 7 days, Ty, the mortgage rate's up half a point. That's crazy.
Yeah, it is wild. And it's interesting because, again, a lot of people in our industry were acting like, you know, their local team just won the Super Bowl. Yeah, everybody was popping champagne and acting like, oh my God, the Fed cut 50 basis points and this is amazing. And people would talk about it and they don't know what, honestly, with all due respect, they don't know what they're talking about. And so again, I want to credit you because I'm learning from you that specifically to watch the jobs market every week, the big report once a month, and really that the job market is going to be one of the big moving factors. Of course, the 10-year as well. Let's keep talking. Let's keep going. Let's talk about CPI. What happened this week and what are your thoughts on CPI this week?
Yeah, so we're going to talk CPI and jobs again here because every you know, the CPI number came out on Thursday, and generally speaking, they were hotter than expected. Right? Again, the Fed's in a tough spot. We got supposedly a strengthening job market and sticky inflation. You know, AKA stagflation, right? It is a possibility. But one of the things I did Thursday morning, and I haven't done this in months, is I wanted to understand the impact of shelter. Because if you've been following me for a year, you know that shelter, which is roughly 32% of inflation, CPI headline inflation, in my opinion, is being misreported drastically. So I wanted to kind of correct for that error. So let me give you the math. This is from memory. Shelter inflation as reported in CPI this month was 4.9%. Its weight is 32%. So if you multiply 4.9 times 0.32, you get an impact something like 1.56 or 158, or let's just call it 16 for easier math. So the shelter impact on headline inflation is 1.6. Okay, what do I do with that? Well, you take the reported 2.3 minus 1.6. Again, I'm rounding for easy math. And you now have a corrected or shelter adjusted inflation of, what is it, 0.8, 0.7, something like that. And that's actually what CPI is. And again, I'm correcting for zero, right? So I'm saying, hey, shelter inflation is not 4.9. I think it's 0. You want to argue with me, you can call it 1. You can do your own adjustments. But there's a very good chance, given the shelter miscalculation, that inflation is already under 1.
Wow.
So the Fed is 1, right? So they should be worried about the job market.
Very interesting. Very interesting. A lot of detail there. Again, thank God we all listen to you on a weekly, daily basis, the daily financial news, the weekly financial news. Man, a lot there to digest.
Let me tie this one more thing out. Because again,
Please.
I've been telling you for months now, jobs. We get a weekly number every Thursday. So the Thursday weekly jobs number shot up. You and I have talked about, hey, as long as it's at 230,
yep,
no problem. It's been there for months. We just got to jump to 258. Early warning. However, again, remember what happened about 3 months ago when Texas got hit with some weather.
Yep.
We saw a blip for 2 weeks. And obviously the north of the east and now Florida have been hit by back-to-back nasty hurricanes. So if history is right, we should see a blip in unemployment for a couple of weeks and probably a big jump in next week's report. So again, is this a sign that the world is ending like the doomers want? Or is this simply weather-related unemployment that will be fixed in 3 or 4 weeks as people go back to work and clean up and rebuild?
Yep.
I don't know, but it's worth paying attention to. Ordinarily, ex-hurricanes, you remove those from the equation, I would be screaming from the hills that 258 is a problem. It's a problem. Watch out. But realizing what we learned from Dallas or Texas weather events, now realizing the horrific nastiness of Helene and Milton,
Yep.
we might get some weekly noise in the numbers.
Yeah. Wow. Very interesting. Very interesting. Just the depth and the detail there. And again, prayers for everybody in Florida and
for sure.
people going through it, man. Gosh, it's gotta be tough.
Frightening.
So,
Right.
yeah. Let's keep moving. So let's talk about Fed speak. I know there was a lot of talk yesterday, a lot of, like conversation about, was it the right decision? Was it, did the other parties, the other board members agree? Talk about Fed speak.
Yeah, we had lots of individual Fed speak, which if I were to kind of summarize it, it was basically what they're trying to say this week is the 50 basis point move is still the right decision. I think they're doing a little bit of CYA, cover your butt, trying to say we didn't overreact, we didn't do this, we didn't do that. I'm not sure that's true, but I think that's what they're doing, CYA. We also got Wednesday what's called the Fed meeting minutes. That was a very interesting read. The meeting minutes basically highlighted that this whole almost unanimous rate decrease of 50 basis points really wasn't that unanimous. So again, as it was reported 2 weeks ago, 18 of the 19, or I guess 13 of the 12 of the 13, voted for 50 basis point cut. One dissent, Michelle Bowman. So we were, or at least I felt we were led to believe it was almost unanimous. The Fed meeting minutes, clearly not unanimous. Lots of people were hemming and hawing. Lots of people were like, hey, I'll take 25 instead of 50. Lots of people like wrong signal, wrong signal, wrong signal. But they did 50 and they made it look like it was nearly unanimous. The Fed meeting minutes, not unanimous. There's a lot of dissent going on in the Fed. And to be clear, that's normal. At transitions, at pivot points, you should have dissension. When you have 9.1% inflation, you better believe they all agree. Raise, raise, raise. So it's not unheard of you have disagreements at inflection points. And I think we're at an inflection point.
Yeah, that makes a lot of sense. And it's interesting too that again, when the Fed did come out 50 basis points versus 25 basis points, one of the things we talked about on this show was is there something that's out there that we don't know about, or banking, liquidity, some issues. And so it wasn't unanimous. And I think that's an important note.
Yeah. So, again, I was very clear. Are they concerned or scared? And they went scared. I think they're scared. I don't know what they're scared of. I think it's also clear that the Fed knows that jobs number on Friday is crap. I think the Fed's like, dude, you just gave me an 818,000 adjustment. You made me look like a fool. So I think they think that number on Friday was bogus. But again, it doesn't matter what we think.
Right.
Rates, cost of capital went up 0.5 point. That really happened.
Yeah,
so
that's
pretty crazy.
Yeah, mortgage market goes up, Fed rate, short-term money down. Stock market seems to be still on a tear. We won't even talk about that today, but let's talk about something that was really interesting in our show notes. 4.5% mortgage rates. What is that?
Yeah, this is wild. So
I'm not seeing it. I'm not seeing it in 2025. What are you seeing, Michael?
So let me just kind of paint the picture. There's a gentleman named David Rosenberg. He's a wonderful economist. He put together a chart highlighting what happened the last 10 times the Fed started to cut, what happened to the 10-year, what happened to mortgage rates, and what happened at the cycle low. Now, MBA Highway, Barry Habib, has taken that exact chart, done some calculation around averages,
Yep.
and basically went out earlier this week and told the mortgage industry that mortgages could go as low as 4.5% given historicals. Now, when I first saw this, thanks, Matt, the mortgage guy, I was like, great chart, see the analysis, but you're missing duration. I had a conversation with Convoy Homes Loans on Thursday who helped me understand duration. Because again, they're in the industry. Convoy Home Loans, shout out Jonathan and Dustin. They basically said the duration ranges from 9 months being the shortest to 60 months.
5 years.
5 years to
Yeah.
get to the low. So now we have a picture. And oh, by the way, the average is 26 months.
Okay.
So the average is over 2 years.
Yep.
So the message of mortgage rates going down to 4.5% by the time we get to the cycle low, I agree. Given the last 9 times, it is possible. But I think it's almost misleading to tell the world that 4.5% mortgage rates are coming without also saying, hey, the duration might take 5 years.
Yeah.
And the reason I say that is because there are so many people that are like, I'll wait for 4.5. Well, what happens if it's 2030? Are you really going to be happy waiting 5 years? You want to rent for 5 years? Wouldn't it be better to buy at 6.5, refi at 5.5, and then refi again at 4.5 in 30 or 2031? I just think that chart is intellectually stimulating, right? Because I like looking at history. I like
Sure.
looking at trends. I mean, I get it. But it is so misleading without duration.
Yeah.
And now, thanks to Dustin and Jonathan at Convoy, we have duration. And it could be as soon as 9 months, not likely. It could be 5 years. It might be 6 or 7 years. Because I believe, as you and I talked last week, I think we are on a very slow and gradual decline. That where the ending might be 4.5, but that ending might be 2030. So I'm pretty passionate. My emails blew up. I got like 7 text messages. Zuber, we're going to 4.5. I'm like, dude, you're not going to 4.5 next year. What the hell are you guys thinking?
No.
It's just, this wishful thinking, this, like you said, this popping champagne and celebrating. I had agents and mortgage brokers text me telling me I was an idiot that mortgage rates are going to 4.5 in 2025. And I'm like, if you morons build a business around 4.5% mortgage rates in 2025, you're going bankrupt. I just don't see it.
I couldn't agree with you more. And I want to also say Barry Habib, brilliant guy.
Oh, he's brilliant. I love it. Yeah.
We had him as a guest on the show. But again, when you put in the perspective of understanding duration, okay, 5 years, 24 months, 28 months, whatever the case may be. Sure. Okay. I could buy into that.
I could. It's not 2025, guys. Don't stop saying that. It's not 2025.
And if it is, it's because there's a lot of problems. We're at World War III. There's something like everything is crashing around us. It's not.
Yeah, be careful what you wish for. Yeah,
it's not a good thing. It's not a good thing.
It's not a good thing. I'll say that again. A 4.5% mortgage rate in 2025 is not a good thing.
Throw out the prediction real quick. I know the numbers.
5.8. 5.8 is as low as we go.
5.8 to 6.25 is what we've been talking about.
5.862. 5.862.
5.862 is the window. Could it dip a little lower? Yeah, based on some news, based on some headlines. Could it go higher? Well, guess what? We just had that 50 basis points.
Yep.
Well, the Fed cut the rate 50 basis points. Mortgage rates went up 50 basis points, folks. Pay attention to Michael Zuber. Okay.
There you go.
Let's talk about opportunities, buyer's market.
I'm getting more and more notes, dude. The buyer's market is real. I got a note from a guy in Atlanta just the other day talking about, I've never seen so many deals on the MLS, writing offers 25, 30% below list and getting counters.
Yep.
And again, this is Atlanta. It's not everywhere, but dude, buyers are pulling back.
Yep.
You don't want to mess with the end of the year, the election, the rates, this, that, the nonsense. Write disrespectful offers. Follow up. Write great deals. write deals that make sense at 6.5%. And then if mortgage rates go down to 4.5% in 2028 or 2029, do a rate and term refi and make more cash. Don't bet on appreciation. Don't do anything stupid. Buyers markets are short windows. I believe this will be over by the spring of 2025. So take advantage. Please take advantage.
Spot on. Absolutely spot on. Let's talk about what's going on. Talk about school community real quick, and then also the Vegas tickets, Eventbrite,
Yep.
February. Tell them about it.
Yeah, so school is something I plan on being known for. I think school in my first book, One Rental at a Time, in this YouTube channel will be what I'm known for after I'm dead and gone. I'm actively trying to build a school community. We were as high as the number 3 ranked real estate investing school. We are now number 5, which means we have competition, more teams. It's all of that's good. I will not be satisfied until we're number 1. I think we need to get to about 350 to 400 students to get there. The price is ridiculous, $20, lots of weekly activities, the group, all of that. But yeah, so we're number 5 and looking to get more growing. So join, ask questions, introduce yourself. We have 3 accountability groups, 10-week boot, thousands and thousands of dollars in value, weekly calls with millionaires. It sells itself. It's $20 freaking dollars. What are you crazy not to join?
$20 a month, folks. Get involved with school. Tell them about the event, the second annual.
Yeah, the second annual ORAT celebration. Now as it gets closer, tickets are selling faster. We're up over 100 tickets sold. VIP is half sold out. VIP gets you access to 3 different 2 lunches and a dinner with all the speakers, which really facilitates intimate conversations. You get 6 hours. You get 2 hours for lunch, 2 hours for dinner. So that's really why the VIP tickets are more meal selections and things of that nature. But I will feed everybody this year. We're gonna go hopefully to 400 people. The agenda, if you go to Eventbrite, is there now. You will hear from new stories from new people. We'll have millionaire panel, lender panel, a surprise hopeful featured speaker, which you and I will talk about off camera. But yeah, it's going to sell out. Tickets are selling faster. Join. General admission, still a great value, $299. You get fed lunch and dinner. Be part of the cake celebration. You get access to all the speakers because they don't leave. So join now. It's getting closer. And again, folks, remember, it's in Vegas. So the longer you wait, the more money you spend. Not for me, flights and tickets, flights and hotels. The longer you wait, the more those cost. So buy now, get your flights, get your hotels, save some money, and come be in this amazing atmosphere of One Rental at a Time.
Folks, buy your tickets. It will sell out. The event had sold out last year. Don't wait till the last minute. Buy your tickets. Michael, thank you for all that you do. Have a great weekend.
Thank you, buddy.